What's up, accounting enthusiast? Welcome to the another episode of the LiaBenefits Series, a podcast designed for you and your journey towards being an accountant. I'm Charlie David G. Viana, your host for today. Hold on because I will be discussing Chapter 4, which is Provision and Contingent Liability. Are you ready? Because I am. So sit back, relax, and let's learn together. But first, let us now discuss our learning objectives. After watching this video presentation, learners are expected to understand the nature of a provision, to know the conditions for the recognition of a provision, to know the measurement of a provision, and to know the requirements for the recognition of a contingent liability and contingent asset. Let us now discuss what is provision. So here, I am not talking about the provision in law, so hindi ito yung mga article na familiar tayo. I am talking about the provision that is defined as an existing liability of uncertain timing or uncertain amount. So it means that it is a liability, but you do not know exactly the amount of the liability or when you will pay the liability. This provision is unique because of its uncertainty. Unlike sa normal na liability, you know exactly the amount of your liability and when will you pay it. For example, umutang sa akin si Jana ng 2,000 pesos para may pang-date sila ng jowa niya. And she said that she will pay it on November 25, 2022. In that case, is that considered as a provision? Of course not, because the amount and timing of the liability is certain. So next is the recognition of a provision. It tells us when we should recognize a liability as a provision. So here are the requisites. First, if the entity has a present obligation, legal or constructive, as a result of a past event. Second, if it is probable that an outflow of resources embodying economic benefits would be required to settle the obligation, and if the amount of obligation can be measured reliably. So let us discuss them one by one. So first, if the entity has a present obligation, legal or constructive, as a result of a past event. Meaning, you have a present obligation that arises because of a past event. For example, may utang ako ngayon kay Fatima dahil nanghiram ako sa kanya ng pera kahapon. So, my present obligation to Fatima is to pay my debt to her because of the past event, which is she let me borrow money from her. Also, it says here that the obligation may be legal or constructive obligation. So, what do we mean by legal obligation? These are obligations arising from contracts, legislation, or other operation of law. Just like in the previous example, Fatima and I enter into a contract wherein she let me borrow her money and in return, I will pay her back. While constructive obligations are the ones that exist when the entity from an established pattern of practice or stated policy has created a valid expectation that it will accept certain responsibilities. For example, let's say that a soft drink company offers a free t-shirt if kapag yung ilalim ng takip ng bote mo ay mayroong number na 1, 2, 3. Now, Angel bought a bottle of his soft drink and fortunately, may number na 1, 2, 3 yung takip ng bottle na binili ni Angel. Now, the soft drink company is liable to Angel to give her a free t-shirt because she had a valid expectation. So, the soft drink company obligate themselves the customers. So, in constructive obligation, ikaw mismo yung gumagawa ng liability para sa ibang tao. So, I hope that is clear. Let us now move on to the second condition, which is if it is probable that an outflow of resources embodying economic benefits would be required to settle the obligation. Meaning, you will lose something in order to settle your liability. Let us say in the previous example, babayaran ko si Fatima. So, in order to settle my liability to Fatima, kailangan ko siyang bayaran ng pera. So, magkakaroon ako ng outflow of resources to settle my liability. In that case, ayun yung pera ko. It is also important to remember that it is probable, meaning the event is more likely to happen than not. So, pag sinabi nating probable, mas malaki yung chance na matuloy yung outflow ng resources kaysa sa hindi. For us to better understand this, let's put some percentage. So, if it is probable, it is more than 50% likely to occur. If it is possible, it is 50% or less likely to occur. And if it is remote, it is 10% or less likely to happen. So kapag probable, more than 50% ang chances na mangyari. Kapag possible, 50-50 or mas mababa pa. And kapag remote, malabo na itong mangyari. And for the last condition, if the amount of the obligation can be measured reliably. We can say that the liability is a provision if the amount can be measured reliably. Ibig sabihin yung amount na na-estimate ng entity ay malapit sa katotohanan. Also, if the liability satisfies the first two conditions but it cannot be measured reliably, we cannot consider that as a provision. With that, let us now tackle the measurement of the provision. It says here that the measurement of a provision should be at the management's best estimate, meaning the entity's best estimate of their liability will be used as the measurement of the provision. The best estimate of the amount that an entity would rationally pay to settle the obligation at the end of the reporting period or to transfer it to a third party at that time. Meaning, the amount must be valid and reasonable estimate of the entity. But now, how do we measure the provision depending on the problem? First, if a single obligation is being measured, the individual most likely outcome adjusted for the effect of other possible outcomes may be the best estimate. It means that if there is only one obligation, measure it based on the most likely outcome, but of course, adjust it for the other possible outcomes. Second, if there is a continuous range of possible outcomes and each point in that range is likely as any other, the midpoint of the range is used. So for example, sabi ni Leona, ang estimated amount daw ng liability ko ay nagre-range from 100,000 to 500,000. So in order to determine the best estimate, we need to find the midpoint of the range. So 100,000 plus 500,000 is 600,000 divided by 2. So the midpoint is 300,000. And lastly, if it involves a large population of items, expected value method is used wherein it weights all the possible outcomes by their associated possibilities. In order for us to better understand this, let us have this illustration. An entity sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that become apparent within 6 months after purchase. If minor defects are detected in all products sold, repair costs would be 1 million pesos. If major defects are detected in all products sold, repair costs of 5 million pesos would result. The entity's past experience and future expectation indicate that 75% of the goods sold will have no defects. 20% will have minor defects and 5% will have major defects. So the expected value or cost of repairs is measured by weighing all the possible outcomes by their associated probabilities. So ang sabi, yung 75% will have no defects. So 75% times 0 kasi wala kang defects is of course none or 0. So, yung 20% daw ng sales ay merong defects. So, magkano yung cost kapag may minor defects? So, 1 million pesos. So, 20% times 1 million pesos is equals to 200 pesos. And lastly, sabi meron daw 5% sa sales ang merong major defects. So, magkano ang cost kapag major defects? 5 million. So, 5% times 5 million is 250,000. So, 200,000 plus 250,000, the total expected value or cost is 450,000. Next are the other measurement considerations. These things must be considered in measuring the amount of a provision. So first, risk and uncertainties. Second, present value of the obligation. Third are the future events. Fourth, expected disposal of the assets. 5, reimbursements. 6, changes in provision. 7, the use of provision. 8, future operating losses, and 9, onerous contracts. So these things must also be considered in measuring the amount of a provision. Let us now move on to the examples of provision. First is warranty. Because based on the previous discussion, in warranty, we don't know when will the product will have a defect and how much will it cost, but it is probable to occur in the future. Second is environmental contamination. When an entity has an environmental policy such that other parties would expect the entity to clean up any contamination. Third is decommissioning or abandonment cost. This example will be deeply discussed later on, but to give an overview, it talks about the obligation of an entity to decommission the site where they install their PPE at the end of its life. Fourth is course case. because during court hearing, you do not know how much is the amount you will pay for the damages to the other party. And lastly, guarantee, because in case that the principal liable cannot pay, the guarantor will be secondarily liable to the obligation. So let us now discuss the another topic for this chapter, which is restructuring. It is defined as a program planned and controlled by management and materially changes either the scope of a business of an entity or the manner in which that the business is conducted. Meaning, the entity modifies its business structure, like changing the scope or the manner of the business, which affects the business significantly. These are the events that may qualify as restructuring. First, sale or termination of a line of business. For example, an entity has a various line of business and one of their line of business is cosmetics. Then, they decided to terminate their cosmetic line because it is not contributing profit in the company. If that happens, the entity is restructuring because they eliminate a line of business. Second, closure of business location in a region or relocation of business activities from one location to another or relocation of headquarters from one country to another. So, for example, your business is located in Region 6, but then you decided to relocate it in Region 4A. Therefore, there is a restructuring because there is a change in the scope of your business. Third, change in management structure, such as elimination of a layer of management or making all functional units autonomous. So, for example, in your company, you remove the supervisor in the organizational chart, meaning you remove a layer of management in your business. Therefore, there is restructuring. Lastly, fundamental reorganization of an entity that has a material and significant impact on its operation. So for example, your manner of business is through online selling and then you decided to change it to a physical store. So there is also restructuring. So when a business undergoes a restructuring, a constructive liability may arise. Therefore, we have a provision for restructuring. Earlier, we learned that constructive liabilities are liabilities arises because the entity obligates themselves to have an obligation. Since restructuring may affect employees, the entity obligates themselves to compensate those employees who will be affected. In order for provision to occur, there are two conditions. First, the entity has a detailed formal plan for the restructuring which includes the following. First, the business is being restructured. Second, the principal location which is affected. Third, the location, function, and the approximate number of employees who will be compensated for terminating their employment. Fourth, the date when the plan will be implemented. And fifth, the expenditures that will be taken. Second, is the entity has raised valid expectation in the minds of those affected that the entity will carry out the restructuring by starting to implement the plan and announcing the main features to those affected by it. These two conditions must be satisfied in order for provision in restructuring to occur. But how do we measure restructuring provision? The amount of restructuring provision shall include only direct expenditures arising from the restructuring. For example, you will relocate your business from one place to another. So those employees who will be removed from the business will be compensated. And that amount will be the measurement of the restructuring provision. PAS 37 paragraph 81 specifically excludes the following expenditures from the restructuring provision. First is the cost of the retraining or relocating continuing staff. Second, marketing or advertising program to promote the new company image. And lastly, investment in new system and distribution network. So these events are not included because they are still part of the entity's ongoing activities. Let us now discuss the next topic of this chapter, which is contingent liability. So based on our textbook, it has two definitions. The first one defined contingent liability as a possible obligation that arises from past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. The second definition defined contingent liability as a present obligation that arises from past event, but it is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured reliably. So the definition of contingent liability is almost the same as provision in a sense that they both have uncertainties. But for us to better understand the difference between the two, let us have this comparison. Both contingent liability and provision indicates that the entity has a present obligation as a result of a past event. Second one, contingent liability is not probable to have an outflow of resources to settle the liability because based on the first definition of the contingent liability, it is only possible to occur, while provision is probable to have an outflow of resources to settle the liability. And lastly, contingent liability cannot be measured reliably, while provision can be measured reliably. Since contingent liability cannot be measured reliably, the treatment for that is to disclose in the financial statements. The required disclosures are brief description of the nature of the contingent liability, an estimate of its financial effects, and an indication of the uncertainties that exists and possibility of any reimbursement. Now, let us also define what is contingent asset. A contingent asset is a possible asset that arises from past event and whose existence will be confirmed only by the occurrence or the non-occurrence of one or more uncertain future events not wholly for the control of the entity. So I will not elaborate this one since it is almost the same as the contingent liability. The only difference is that it is an asset. But before we proceed to the last topic of this chapter, let us have a short assessment on the treatment of liability and asset based on the chances that they will occur. So, if the liability is certain or 100% to occur, it is recognized. For asset, if it is certain or it is 100% to occur, it is also recognized. If the liability is virtually certain or 90% to 95% that it will likely to occur, it is also recognized. And for the asset, if it is virtually certain to occur or 90% to 95%, it is also recognized. If the liability is probable or more than 50% likely to occur, it is also recognized. But if an asset is probable or more than 50% likely to occur, it is just disclosed in the financial statements. If a liability is possible or 50% or less likely to occur, it is disclosed in the financial statements. And if the asset is possible or 50% or less likely to occur, it is just ignored. And if the liability and asset is remote or 10% or less likely to occur, it is just ignored. And lastly, if the liability or an asset is impossible or there is no chance that it will occur, it will be ignored. So our main concern here in this table is the probable or more than 50% likely to occur and the possible 50% or less likely to occur. So the probable one is the provision and the possible or 50% or less likely to occur is the contingent liability and contingent asset. This treatment of liability and asset is based on the principle of conservatism, wherein we record when it is unfavorable for the entity. For example, it is probable for the entity to incur a liability. Let us say, Maya is my boss. When Maya asked me to present a financial statement and she saw that we will incur a liability. Pero kapag mas mababa pala yung amount ng liability na na-incur ng company, edi mas matutuwa pa yung boss ko na si Maya. Pero kapag it is probable na mag-acquire ng asset ang entity, syempre aasa si Maya, yung boss ko, na magkakaroon kami ng asset. And if ni-recognize yung probable asset, pero hindi naman pala namin ma-acquire yung asset na yon, baka magalit pa yung boss ko na si Maya kasi umasa siya. Kaya i-disclose na lang siya sa financial statement kapag probable lang na mag-acquire ng asset. I hope you guys are getting the point on why we recognize, disclose, or ignore the chances of occurring of a liability or an asset. So next, let us discuss the decommissioning liability. So, a decommissioning liability is an obligation to dismantle, remove, and restore an item of property, plant, and equipment as required by law or contract. A decommissioning liability is also called asset retirement obligation. So, for us to better understand this decommissioning liability, let us have this illustration. On January 1, 2021, an entity engaged in extracting natural gas and oil constructed a drilling platform for 25 million and is required by the Philippine law to remove and dismantle the platform at the end of its useful life of 10 years. The straight line method is used in depreciating the drilling platform. The entity had estimated that such decommissioning will cost 5 million pesos, and based on a 12% discount rate, the present value of 1 for 10 years is 0.322. Thus, the present value of the commissioning liability is 5 million times 0.322 or 1,610,000. So the decommissioning liability is initially recognized at present value and included in the cost of the related asset. So let us have the journal entries for the year 2021. So in January 2021, we debit the drilling platform for 26,610,000. We credit cash for 25 million, which is the amount of the drilling platform, and credit decommissioning liability for 1,610,000. And on December 31, we record the depreciation of the drilling platform. So we debit depreciation expense for 2,661,000 and credit accumulated depreciation for 2,661,000. So how do we get the amount? We simply divide the amount of the drilling platform, which is 26,610,000, to its useful life, which is 10 years. So 26,610,000 divided by 10 years is 2,661,000. And also, we record the interest expense. So we debit interest expense for 193,200 and credit decommissioning liability for 193,200. So how do we get the amount of 193,200? We just simply multiply the 12% discount rate to the decommissioning liability, which is 1,610,000, which will result to 193,200. And for the year 2022, here are the journal entries. So on December 31, 2022, we also record the depreciation of the drilling platform. So debit depreciation expense 2,661,000, credit accumulated depreciation 2,661,000. So in December 31, 2021, the carrying amount of the drilling platform is 23,949,000 because we deducted the accumulated depreciation for the year 2021 in the drilling platform. So, and the useful life remaining is only 9 years. So 23,949,000 divided by 9 years is 2,661,000. And to record the interest expense, we debit interest expense for 216,384 and credit decommissioning liability for the same amount, 216,384. So how do we get this amount? Simply multiply the 12% to 1,803,200. So how do we get the amount of 1,803,200? Since on January 1, 2021, we have a decommissioning liability of 1,610,000 and the interest expense for 2021 is 193,200. Add those two and we will have the carrying amount on December 31, 2021 of 1,803,200. And to get the interest expense for the year 2022, simply get the 12% of the 1,803,200. Now, let us discuss the settlement of the decommissioning liability. So, let us continue the previous example. So, on December 31, 2030, after 10 years, the entity contracted with another entity to dismantle and remove the drilling platform for 5,500,000. So, here is the journal entry. So, December 31, we debit the decommissioning liability for 5 million, which is the estimated amount on January 1, 2021. We also debit the loss on settlement of decommissioning liability for 500,000. Credit cash for 5,500,000 since it is the amount to dismantle and remove the drilling platform. So the difference between the decommissioning liability and the cost of dismantling and removing of the drilling platform is the loss on settlement of decommissioning liability. Next, the journal entry to recognize the carrying amount of the drilling platform on December 31, 2030 is debit accumulated depreciation for 26,610,000 and credit drilling platform for 26,610,000 also. Lastly, let us discuss the change in the decommissioning liability. Under IFRIC 1, changes in the measurement of a decommissioning liability, shall be accounted for in the existing following manner. First, a decrease in the liability is deducted from the cost of the asset. Second, an increase in liability is added to the cost of the asset. So for us to better understand this, let us have the same example earlier. So I will not read the illustration. So the journal entries for the year 2021 is the same. So debit drilling platform 26,610,000, credit cash 25 million, credit decommissioning liability for 1,610,000. So this is the additional problem. However, on October 1, 2021, the entity had estimated that the present value of the decommissioning liability had decreased by 800,000. So to record the decrease in the decommissioning liability, we debit decommissioning liability for 800,000, and based on the IFRIC 1, we will deduct the decrease in liability to the cost of the asset. So we credit drilling platform for the amount of 800,000. So next, before we compute for the depreciation expense, let us first compute for the carrying amount of the drilling platform. So on January 1, 2021, the cost of the drilling platform is 26,610,000. So less the reduction of the decommissioning liability worth 800,000, the carrying amount of the drilling platform on December 31, 2021 is 25,810,000. So divided by 10 years, which is the useful life, the depreciation for 2021 is 2,581,000. So to journalize, debit depreciation expense for a 2,581,000 and credit accumulated depreciation for 2,581,000. And also, before we solve the amount of the interest expense, let us first compute for the carrying amount of the decommissioning liability on December 31, 2021. So here we have the amount of the decommissioning liability on January 1, 2021, which is 1,610,000, less the reduction of the decommissioning liability worth 800,000. So the carrying amount of the decommissioning liability as of December 31, 2021 is 810,000. And to get the interest expense for the year 2021, multiply it to 12% and we will get 97,200. So we debit interest expense for 97,200 and we credit decommissioning liability for the same amount of 97,200. If you enjoyed this episode, please like and subscribe so you will be notified when a new episode is posted. Rate and review this podcast and share it with your friends. Thank you so much for listening, and we hope that you are able to catch up new lessons that will help you on your accounting journey. Get that CPA title because we believe in you.